Good morning, ladies and gentlemen. Well, last week I was completely and utterly wrong. Absolutely no bearishness in the market at all for risk assets. We're stuck at 89. We've been at 89 for an awful long time, and we just keep on slowly improving. I am not changing my mind. I am still turning bearish, and I will explain to you why, and I'll explain to you what I have done to hedge my long-term holdings. It's unrealistic to expect that the risk dial is going to catch a quick change in trend for a binary event like a potential COVID wave. We shall discuss the potential COVID wave and ways that you can cheaply hedge your portfolio and still participate in the potential upside. As you can see from this chart of the Blue Angels, the Wall Street analysts have done it again. They've started upping earnings towards 180. The odds of achieving 180 if we get a second COVID wave are, to me, zero. I think that we'll be much closer to 140 or 150 rather than 180, and that is going to put us much lower than we are. So I still think that the risk reward at these levels is not good. In fact, I think the risk reward at these levels is extremely bad. The odds of us keeping at times 22 with the yield curve continually steepening are not good either, and therefore we could get a double whammy both in terms of earnings and in terms of multiplier, and that puts the market a lot lower than we are at the moment, while the upside is very much capped to that 180 if it's achieved. 180 times 22, what is it? It's in the 3900s, but that is less than 100 points away from here. So really the risk reward is very much on the downside if we get a binary event. I keep on reiterating that you should download deviations on a daily basis, and that is because it's following the deviations very well. Every time we get into the red, we come back, we slowly open this up. You can see where the middle line is that divides the bullish and the bearish trend, and it seems to be working extremely well. Every time we get into the red, for example here in XLB, we back off. We did the same for XLK, and slowly we're going up them. The risk reward to me is very much on the downside. A, because we're so close to the top of the red in deviations, but also because of the possibility of a binary event. You have seen how there's been this UK variant and the South African variant in Europe. And the mathematics say that the cases are going to be transmitted sometimes between February and March. If the same happens in the US, that'll be Janet Yellen's first big test at the Treasury, and let's see what she can do. But the first reaction of the market is going to be very much on the downside. While XLY is up here in the red, and while XLK is so close to the red, the two biggest sectors, and we have QQQ into the red as well. Now, can it do this and then down? Absolutely, but this shows you where we are in terms of risk reward. The risk reward from these levels, whether it goes up 1, 2, 3, 4, 5% more, is very much skewed to the downside. So with a market where we are skewed to the downside in terms of risk reward, we have to start thinking of how to hedge, what the best strategies are, but also leave us some room to have some free upside as well. The bond market is very much still flashing at some warning levels. The 2s10s have really not done very much this week. I keep on saying that above 100 basis points, it's very, very expensive to hold this position. To be long of 2s10s and looking for a steepening, you really have to time it perfectly, because the carry is killing you all the time. I really can't see it busting through this 104 level, so I think it's more likely to go down towards the 87 level. I have not changed my mind there. In terms of bunds and bobbles, and this is the bobble, we have some very, very good levels that we should look at. Basically, here we have minus 68, minus 69 basis points. If we start going through there for whatever reason, we will be looking for minus 61. I don't expect it to happen. I think that bonds are likely to remain bid for the next couple of weeks, because the danger of the second COVID wave is just too high. But if we have a look at the 10s, the bunds, we have here the level minus 46 basis points. It's going to be a very, very good level. If we go through there, then basically what the market is saying is that it's not afraid of a second COVID wave, and that the continuation of risk on is going to be very, very strong. My favorite would be for a slow move back to fill these gaps down towards minus 60. That would be my favorite, but as always, I will listen to what the market is saying. I mean, if we start going through these levels, then the market is saying that it's definitely not afraid of a second COVID wave. There is no doubt that the steepening tendency in the yield curve in the States is just not abating. I mean, if we look at 5s, 10s, here we go, we are about to reach this minus 73, minus 74 level, or 74 basis points positive, whichever way you prefer to look at it. It really makes no difference. And if we look at 5s, 30s, which is my favorite indicator, it's bust the 100 and you can see how now 154 is the next level. These are such important levels. I mean, I didn't really think it would go through 140 because it's so expensive to carry. And, if we start going through 154, then the bond market is really shouting inflation at you. This is bound to impact all the other asset classes, because my main argument for why risk assets are at the price they are is because bonds are so cheap. Long-term bonds are so cheap, and therefore the multiplier can be high. Can the multiplier really be as high as it is if we have, bond yields going up and going basically even towards the positive level in real terms? I don't think we can, and I think it's all an accident waiting to happen. But for the meantime, let's see what happens at 154 basis points positive. We start going through there. I mean, it's going to be the end of the world, and basically, the Fed is going to have to do something fairly dramatic, because if it doesn't, it will reflect in all asset prices, I can promise you that. If we look at an outright yield chart of long bonds, well, 190 is still the all-important level, and we're just holding below it. But this could be a little wave ABC that holds this, 175 area, something like this. And on if we look at TLT, maybe it goes back up towards this, 154, 155 area. But if that is all that is happening, the odds of breaking this all-important 148.90 start increasing. If we look at how important that level is, to me that is a very, very important level. Below 148.90, very bad things happen to bonds. We could go all the way to 136, 137 down here, and if that happens, I just cannot see the multiplier being at 22 times. If we look at what happened in this area here, we were a multiplier around 19, 20. And if that happens, very, very bad things are going to happen to equities. Well, the dollar, what to say about the dollar? 91.01, as you can see, is pretty key. What happened last week? Ticked it straight back down. The dollar needs to remain weakish to get away all this huge bond issuance that's going to happen in the first quarter of this year. There is no doubt that a weaker dollar helps draw in international investment into treasuries. If you're not going to make money on the yield side, you have to make money on the currency side. So I just am not changing my mind. I am neutral to bearish on the dollar. I'm bearish longer term. I'm neutral shorter term. We're just basically repeating this kind of pattern, and you can see how many weeks we're here. We're here for like 3 or 4 months. I really see no reason why we shouldn't remain in this 91.01 to 88.44 area for a very, very long time. Allow all these moving averages to come down and then potentially break it. So neutral for the first 2-3 months of this year. I'm hoping all the time for squeezes up towards 92, 92, 62. That would be a wonderful risk-reward level to trade, but at the moment we're just not getting it. It's far more profitable just to sell calls up there and just leave it alone in terms of outrights. I have almost nothing new to say about gold. If you have a look at this chart, it's holding these levels which have been marked forever extremely well. Although I'm beginning to think that the risk reward is turning towards a breakdown of 1764.5 and possibly down to 1658. Why do I begin to think that? As the dollar does nothing, and as bond yields and as the yield curve keeps on steepening, as long-term real rates become less negative or go towards more positive levels, the correlation of gold is with long-term real rates. As those go up, I think gold could have a very strong liquidation phase, which doesn't mean it's not going to be a wonderful level to get it, to buy it down here for the longer term. But the first move is going to be one of liquidation before it starts going up. The risk reward is turning against gold at the moment. So I'm still a buyer at 1764 for a move up. Last week what happened, we got 1810 and bounced off it, but the bounces seem to be weaker and weaker. So at some stage we will close below 1810. I have no doubt we will trade 1765, bounce again towards 1810, and then probably break down towards the 1658, but one step at a time. Still a buyer at 1764, 65. I see no reason why that shouldn't hold first test round, but the risk reward is turning now against gold, going higher. I still think it's in a trading range. I just don't think it's going to bust these upsides for quite some time. This is by far my favorite way of looking at SPX. This area of trading here between 36.46 and 38.26 is basically rubbish. There is no significant level in there is going to withstand the test of time. Basically, I think that if we start moving down through 3826, we are potentially in a cascade environment. Certainly down to 3645. Why am I saying this? I just don't see these levels, this trading here, as being anything, creating any levels which are foolproof. It's just an expanding, and it's just basically rubbish. It's like this stuff here, which when broken and retested, and then we just fell apart. Now, if we are talking about a second wave which could manifest itself in Europe, say in 2 weeks to 3 weeks, and in the US, with much higher levels of infection, say between the middle of February to the middle of March, then these levels are just not going to be levels that hold it. I would suggest that these are levels that hold it around the 3200 area. Mathematically, does that make sense? I've made some early calculations, and yes and no. I will definitely like to be a buyer down here around the 3200 level, but it's a binary event. So what I'm saying is it's either going to happen or it's not going to happen. It's not going to happen somewhere in between a yes or a no. So either we do have a second wave, and Twitter, and we've had conversations about this. What can I say? I have absolutely no clue whether it's going to happen. All I can do is prepare myself and have a game plan if it does happen. And also, if it doesn't happen, we will know whether it's happening or not, because the newspapers will be full of headlines. There will be reports of actual infection numbers, and also the market will be reacting in real time. So it's not a question like we won't know, but it's something that could happen in a month's time, or it could not happen at all. So in the meantime, what do? In the meantime, we prepare and we have a look at the levels that the market will be telling us very, very important things. The first level is 38.26, and the next level is 36.46. Nothing in between really tells you anything. My favorite is that we go down and we test this level, and we trade this area again. But we have earnings next week, very important earnings. Basically in the next couple of weeks, we have everything, all the major companies reporting. Something like over 50% of the S&P will have reported in the next couple of weeks, and therefore you cannot exclude the possibility that the market just keeps on going higher, trying to discount that $180 that the analysts are trying to persuade you that we'll get to. 180 times 22, 39.50. So another 100 points on the upside. Is it possible? Absolutely, it's possible. I just think that once you get there, the risk reward is so fantastically skewed to the downside that it's not really, it's ridiculous. But here is what the way I'm looking at it and what is giving me clues at the moment. There is no doubt that the biggest losers from a new COVID wave will be XLF and XLI, and the biggest beneficiary will be tech, big tech, where the earnings are, where the most stable earnings are. If we look at XLF, XLI, what's it done? It has, XLF, XLK, it's really lost quite a bit of ground last week, which basically tells you that the market, yes, it is beginning to be worried. I would have thought that if we go below this 22 level that we held as support, that will be the first indication that we are very much in a market is worried period. If we have a look at this is XLI over XLK, you can see it's breaking down. I would not be surprised to see it go all the way down to the lows of July and October. And this is the important one. If we look at the Qs over SPY, which is basically the same chart as the SPY over the NASDAQ, it's identical, isn't it? It's easier for people to see. We are beginning to test the worst level that we were at in the summer of last year. So the market is worried. Okay, I mean these spreads are telling you that the market is very much thinking about the possibility of another wave and positioning itself more in tech and less in everything else. Now the one place where this has not been reflected is in Qs against IWM. The speculation, the ridiculous speculation in companies which are loss-making and forcing them to go up 25-50% per day is, affecting this spread. This could be potentially the best spread to have, and that's why I keep on saying, if you are a long-term investor, you have to keep away now from IWM, from these Russell stocks, because that, at the moment, is an accident absolutely waiting to happen. If we start going back up through this 157.78 level, I think we could have a very sharp move back up to this 200-day moving average to around this level. What's that? 170. A very, very quick move in a couple of days. So to me, IWM is very, very vulnerable to a COVID wave and the market response to it. I really don't know what to do with IWM because it's so volatile, but that tells me that it's in a void, and really keep away from it. Just do not be caught in it, because when it starts going down, it's gonna start motoring percentage points per day, and I mean like 4, 5, 6, 10%. It's going to be brutal. There is no doubt in my mind that the best hedge for longs is volatility. We are still at a level of volatility which is, I wouldn't say cheap, but certainly not that expensive. We have been basically in this range from 20 to spikes to around 30 for a long time, and we are now closer to the bottom of the range than the top. This is one market which is actually telling you that either the hedging has already taken place or that the market is not that worried as yet. So take your pick. I tend to think that it's more that the hedging has already taken place and it's only just marginal people which need to hedge. But if we have any kind of indications of a second wave in the next 3 or 4 weeks, volatility will spike to fill these gaps on the daily chart. And this gap here is up to around 34, 35. That is a very decent risk reward. So that is probably the cheapest way for you to hedge your portfolio. Just buy some volatility. My favorite is volatility in Europe, for very simple arguments which I'll show you. This is a chart of volatility in US against volatility in Europe in H21. It's a bit of a mess because you get these spikes on the upside and the downside because of the difference in trading hours. But really, I can tell you, and believe me, it's trading between 370 and 300. That is the area that it trades in. It didn't close down here, it really closed at 340. And if you can get it between 340 and 350 to the downside, at that kind of differential, I prefer to buy volatility in Europe. Why? because volatility in Europe is much less liquid than volatility in the US. What tends to happen is that people hedge their European holdings with the US volatility because of the depth of the market, and then volatility in Europe catches up, you know, a few days later. Secondly, the markets which are going to be most affected by COVID and earlier affected are going to be the so-called value. So you're talking about the financials, the industrials, all sectors which are especially heavy in Europe, and they have very little real tech. And therefore, the move in the European equities tends to be actually stronger than in the US indices, and therefore this spread should actually come a lot lower. Over time, this spread tends to go down into the 200s as we approach the expiry of H21. So it's a relatively cheap way of just buying European volatility. Given that we are so low in overall volatility, that buying European volatility to me is probably one of the best trades you can do at the moment, the one with the best risk reward. So now let's look at what could happen, okay, and we're talking about a binary event. So does the COVID take place or not? I have no idea, but how to hedge the potential of it happening. First of all, if we just look at the 195-minute chart, this market is doing nothing wrong. Okay, this market is doing absolutely nothing wrong. It breaks a level, it does a bull flag, and it breaks higher. So this is a market which potentially, it's telling you very loudly that it's not worried about anything that much at the moment. It's shifting into tech, but it's really not doing that much at the moment. That is very worrisome. This is a daily chart, 36.46. That is the really important level. Everything else has been, nothing much. As long as we keep on holding this red moving average, which is called every low, we never close below it. What is that in the next few days? 37.60, probably 37.70 in a couple of days. As long as all we're doing is testing that line and bouncing off it, it's a market that's not really worried. It's on the weeklies that we should worry, because you can see this line, this red line, how it caught every single low. Look at these, look at these. This will be in the next week or so, it'll be back up towards, I would argue, around the 3600 area. Okay, so that is the one that is the important, that is the move that you want to hedge down there and below that level. If all it does is hold here, there's no worries, it'll go back up. So now let's look at how best to hedge without losing out on too much upside. So given that 36.46 is the level to hedge, what have I done? I've sold my tracker longs. I've had them for months and months because this is going to be a binary event. I just can't see that either we have it, and in which case things will be bad, or we don't, in which case we probably get the J&J vaccine in the next month and a half, and that will actually considerably speed up everything, and the market will start going parabolic on the upside. So I don't want to miss on the upside, and I want to have some hedge on the downside. That is going to cost, okay? There is no way to do it free, but what I've done is I've sold my tracker longs. I've bought 38.50 calls for 96 days into April for 142 ticks, and I've sold the 32 puts for 30 ticks. These are down here on the at the lower Bollinger Band of the weeklies, because that is my reset level. And all that is costing me basically 3%. So I'm foregoing 3% of the upside for a potential reset 20% lower if there is a bad outbreak of COVID. In the meantime, I'll be able to trade all this and actually not worry about, because I'll have no position. I won't be worried about the 3200 puts, and the 3850 puts. If it starts going calls, if it starts going down, I can just sell them and be very, very happy with myself. If you cannot sell your longs for tax implications or whatever, you know now what the level to hedge is, 36.45. As long as the market stays above 36.45, these are just all minor events which do not worry you, because the market will come back. April is plenty long enough. What you do is you buy a 3200 put spread, which is 55 ticks or around 1.5%. Because if it starts going through here, very bad things are going to happen. So basically for 1.5% you have hedged that possibility. Going on to the summary sheet, I'm not really worried about the 2s, 10s. I'm much more worried about the 5s, 30s. Having gone through 140 on a closing basis, 154 now is beckoning, and that is really, really worrying. So I'll be watching that one very carefully. DXY, I've told you, 91.01, 92.62, 88.44. That's where it's trading. It's really doing nothing, and really makes sense that it does nothing, that it has no big spikes on the upside, because they have so much funding to get off in the next 2 or 3 months. That keeping the dollar low, I think, makes more sense than not. Gold, I think the risk reward is trading. Is changing down towards this 1705 level rather than 1810 and 1765. 1810 might get a couple of bounces, 1765 better bounces, but 1705 I think is where the real support is going to be now. I don't see 1915 or 1915 to 1925 challenge for quite some time, and I think if you see anywhere close to it, it's a mega sell. SPX, I've told you, in detail. I think the first warning sign is 38.24, and then 37.76. It's earnings. Everything I've talked about is not going to happen next week. It's going to happen in the next month and a half. So next week with earnings, I think the odds of breaking 38.24 are not all that high unless the earnings are bad, and I can't imagine they will be bad. What I think the market is going to start discounting is that, after the earnings we get the COVID wave. So I can't see that we can have anything but a very slow grind along the red deviations curve. 38.50, 38.60, 38.70, but it's going to be a very, very slow grind upwards that I'm really not that worried about the upside. NQ seems to be where people are now going to in terms of positioning for a potential COVID and the earnings next week. So that is certainly more bullish than the XPX. These are the key supports, but I think that the momentum is behind NQ and the QQQs, and therefore they should continue to outperform the SPX. That's why I think there's no real resistance until we get to 13,700-ish on the weekly Bollingers. EEM, what to say? It's achieved absolutely everything. It's at all-time highs, having bust a 2-decade range. To me, that will continue to outperform. That is not that's not a short-term view. If we get a COVID spike, EM will get hurt the most. And therefore you will see these levels. But that is something that, you know, we will talk about in the next month or so, not something that should worry us in any way next week. What we could do is on any dip buy some VIX or European volatility, as I showed you, which is very, very attractive because the yield curve there is so flat to cash. To me, that makes the most sense, and that's what I will concentrate on doing. This is just a nightmare. It's still at 178, having moved 3-4% during the week up and then straight back down on the Friday. If you're a long-term investor, please get out of IWM. You will be very glad one day that you did. Okay, thank you very much indeed. I hope I've given you some hedging ideas, and I'll tweet you on Monday.